This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Since we can't make sense of the tariffs, we'll move on to a leading economic indicator who clearly showed this week that it can't make sense of the tariffs. That and an important update on one of the biggest banks on this week's Wise Investor Show. Hey, welcome to the Wise Investor Show podcast. I'm Chase Henderstein. And this week, what moved the market was anticipation or pessimism about a trade deal with China. But as of the time of this recording, there's really little tangible news about that other than Trump saying that the Chinese are hard to deal with. So we'll focus instead right now elsewhere. So other notable events this week, we had a release of really ostensibly the most important leading economic indicator. We got the May reading on the PMI data, as well as a highly cited speech by Jamie Dimon. And he talked about basically what he said, the inevitable crisis in the bond market. So we'll talk a bit about that today, as well as a big update for another bank, Wells Fargo, but I'll address that later on. First, let's take a quick glance at where we actually are today, really just about halfway through the year, of course. And the S&P has now managed to get into the positive territory, up about 1% for the year, boosted again by strong gains from those concentrated positions in the artificial intelligence kind of type companies, while the less tech-heavy Dow Jones Industrial Average, it remains slightly into the red for the year. They're both about flat. The big economic indicator for the week, though, it had actually a bevy of supporting indicators released, but I'm not going to go through them all. But the big one was the ISM Services PMI data for May, surprisingly slipping into contraction territory, barely, as a reading of 49.9 versus the FactSet consensus estimate, which was for expansion territory, a 52.2 reading. And the reading for the previous month was 51.6. Now, there were other releases also in the red, but they focused more on manufacturing. Now, I'm not focusing on the PMI manufacturing. It's a smaller portion of the economy. There's also a bunch of noise in the manufacturing sector right now. There's inventory buildups, and then they got ahead of themselves. A lot to do with the anticipation of tariffs. But seeing a dip in the services PMI, it was a bit more of a surprise. This is notable because the PMI reading is derived from surveys of purchasing managers across both manufacturing and service sectors. And I'm focusing here on the service one. Its importance lies in its ability to signal economic trends before they actually appear, before you'll see it in what's lagging data, like the GDP number or employment figures. Those are not leading economic figures. They're important for other reasons. They're important for the Fed, but they're not leading economic indicators. And it's a look at what's being loaded up, kind of being loaded into the chamber or not, before the business itself pulls the trigger. The PMI is based on 5 indicators here. We got new orders, inventory levels, production, supplier deliveries, and employment. And all those components are weighted and they're kind of scored together on a basic score level of 0 to 100. And we've gone through this over the years, but a PMI reading above 50 indicates that the sector is in expansion, while anything below 50 suggests contraction for that period. And readings around 50, much as where we are right now, well, they just reflect stagnation. Overall, while it is considered a leading indicator, it's really a reading purely on direction. It's not magnitude. So while we did slip below 50 with that 49.9 reading, that's basically a rounding error. Much of the economy right now is taking a wait-and-see approach as businesses, they're not prepared to stick their necks out right now with big expansion budgets. Not when there's so much uncertainty, but their budgets and the balance sheets are really pretty strong right now. So there's kind of this kinetic energy building up in corporate America if we can indeed eventually get through the tunnel of trade threats and supply chain disruptions. It's weird. I'm not going to get into it too much this week, But there was a lot of talk on the analysis I've been receiving all week on the offsetting amount of income derived from tariffs versus the income lost in the budget proposal and how much of the deficit would be offset by that. And the flaw, I guess I would say, with that logic, or the disappointment, I would say, depending on how it worked itself out, is the tariffs by many are not considered to be a permanent institution. Maybe this 10% underlying tariff, which is basically all we're actually dealing with today, may be permanent or maybe be 3.5 more years. Who knows? But to really use a measurement of budget deficit impact and to use tariffs as an offsetting source of revenue in that presumes a lot, which I'm certainly not willing to do at this point. And then you have to consider the other ramifications there. The inflationary impact long term. We talked about the difference between real inflation and how tariffs are a cost spike and so on. Either way, tariffs have other ramifications that are not part of that simple equation. Moving on, the other big news that grabbed a bunch of headlines over this last week was that Jamie Dimon made an appearance at the Reagan National Economic Forum last Friday. Jamie Dimon is the CEO of JP Morgan, and it's a bank that, by the way, one that I own and we own for our clients. And while I'm not going to focus too much on the specific fortune of that bank here as an investment idea, this is relevant to them and my conflicts of interest as it relates to the company, because I carry this biased view in favor of the bank and the stock going up, which is why we own it. That being said, I've actually been tracking Dimon for decades, way back since I worked at Smith Barney in the 1990s. And he was Sandy Weill's heir apparent at what was the parent company at the time, was Travelers. And it was really considered just a matter of time before he became the CEO of what was then really, I guess, more or less the biggest bank in the world or financial institution. Until he suddenly left one day. We came into work and Jamie, not that he was in my office, but he had left the company. And one day I'd really like to find out what truly happened there. But to digress, Jamie's made a few appearances over the past week or so. And he also reiterated in an interview that he's not retiring anytime soon. He said, unless God or the JPM board has something else to say about that. But what got the real attention was his appearance at the Reagan Forum, where he said that we are going to see a crack in the bond market. That simple sentence created a lot of press. He went on to say that it could happen within the next 6 months or the next 6 years, but it's going to happen. And I don't carry that same baseline assumption that it's inevitable as he's saying, but I also operate from the point of view of mitigating risk exposure as kind of my primary mandate, as long as it's done in a reasonable way. So while we don't make a practice of modeling for Armageddon here, we certainly are on guard for signs of it coming. Now, his reason for the prediction, and by the way, he also went on to say that JP Morgan would not only be prepared for such a financial crisis, but ultimately that they would profit a lot from them, as they have in the past. But his main focus on this was the extent of the federal debt and the potential to add trillions, now trillions more, based on current proposed legislation here in D.C. Now, that debt alone wouldn't cripple the balance sheets of corporate America, but any type of kind of collapse, as he's suggesting, or a real downturn in the value of the Treasury market would have a cascading effect on other bonds and bonds from the corporate world as well, as it would make also then corporate borrowing costs much, much higher. So it has a serious economic impact. And per a Forbes article this week, which was reacting to Jamie's speech, they too say it's not inevitable, but they suggest investors could protect themselves against this risk of a crack by reducing long-term debt exposure in favor of short-term debt, as well as investing in the financial service providers and energy utilities, this is them talking, which may benefit from the higher ensuing interest rates. Now, I'm not so sure about the latter, because utilities also carry a decent amount of debt themselves, often on their balance sheets, and they're also usually looked at primarily for their yield, which is that much less competitive if all other yield instruments are rising, or the yield on those instruments are rising. But if rates did rise in a somewhat orderly fashion, then a steepening yield curve would certainly benefit the financial services sector, as they're describing. The Ford piece went on to say that there's some moderate chance of Dimon being right. Go figure. He's most notable banker of all time, maybe, but so there's a chance of him being right, explaining that he went on to point to regulatory limitations and a potential lack of liquidity that would exacerbate, if not lead to, that crisis. Specifically, Dimon was saying that new regulations that came in the wake of the 2008 financial crisis, it's now limited banks from what they could carry on their balance sheets, essentially what bonds or how much in bonds they could buy, and it therefore limits their ability to be the liquidity provider, the provider of support should a crisis develop. Nonetheless, though, Forbes went on to point to strong underlying economic reasons why this is unlikely to unfold anytime soon, if ever. But a reason why the stock market gets squirrely, and we've talked about this kind of demarcation line, when the yield on a 10-year Treasury rises above 4.5%, is a frothy bond market is a sign of a problem and a huge dip in liquidity, and has many tendrils of ramifications to the economy. But today, that 10-year Treasury is sitting somewhat comfortably at 4.4%. So we have a little wiggle room. It was over 4.5% just a couple of months ago. All right, I'm going to slip into a quick break here, but when I return, maybe a more actionable segment for you, as I give an update on another bank in our portfolio, which had big news this week. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Almost everything that lagged last year, value, international, and more defensive stocks, have held up relatively better here in 2025. Is this just a knee-jerk reaction or a more sustainable trend? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. The other story of the week that really grabbed me, especially because, as the disclaimer goes, this is a stock which I own personally and which we own for our clients. And it was the news that Wells Fargo, symbol WFC, after, 7 years here, they're no longer going to face the additional restrictions that were imposed on them by the Federal Reserve regulators after their account scandal of that time. I don't want to make light of it. It was fraud. They're pushing and pushing and pushing their CEO at the time, their branch associates to grow revenue and fees, and they're doing so by fraudulently opening basically just shadow accounts for their many, many customers, which incurred fees for those customers even though there was really nothing in them. Anyway, maybe not that CEO. I can't even recall his name, but the bank itself owned it. Management today is still perceptibly ashamed of it and admits the punishment was fair. But today, they're finally starting to really move past it. In fact, their current CEO, who was brought in to fix this mess, Charles Scharf, said that addressing these institutional and cultural shortcomings took about 50% of his time as CEO over these past 7 years. Now, the relaxing of the weight and the oversight of these restrictions will not only free up capital, but also that institutional effort throughout their systems that they were set on installing internal systems of oversight and management to satisfy the regulators and to satisfy the customers that they've made things right and that they're ready to move on. To be fair, there were expectations that this was coming. This news was welcomed by some this week, but it's been talked about since the first quarter this year that this was going to happen. And it was part of the thesis for the stock early this year. And really what I found odd is we had to look this up. Wells Fargo stock has actually outperformed the underlying banking index as well as those specific banks that we bothered to compare it with over this time frame. So the stock has been fairly decent. But I guess that means imagine what could have been if they hadn't messed things up so badly, as I try to choose my words carefully. The CEO, Scharf, went on to say he believes this may have cost the bank hundreds and hundreds of billions of dollars in deposits and assets under management. Market share that they now expect to go after and hopefully claw back. They had been restricted on how much capital they could take in as a bank. They literally had to turn some customers away, trying to focus on, I guess, those that were most profitable to retain them. And they were facing restrictions or had faced restrictions on how they could deploy their own capital. But now, according to Scharf, they'll be able to raise their dividend more reliably. They'll be able to buy back shares and deploy excess capital into expansion like they couldn't before. Per a JP Morgan report regarding this news, JP Morgan said that in 2024 versus 2018, before the restrictions, Wells had to spend an additional $2.5 billion and added 10,000 employees, focused in the areas of risk and control related groups, many of which could be, I guess, repurposed, let go, or attritioned. Now, anyway, a great deal of that, though, was also spent or more spending on outside consultants. As JP Morgan said in their report, that Wells saw expenses for consultants and attorneys, for lawyers, rise to $6.7 billion in 2020. That's a lot of legal fees, up from $4.3 billion in 2016, and that today they're on track to get back towards that 2016 level. They're not quite there yet, but they're on track for that. And additionally, JP Morgan points out that one area that will benefit the most may be commercial lending, which had been limited by the cap, and commercial deposits had shrunk from $465 billion in 2017 down to a trough of $317 billion in 2023. And they're already rising. It's already back to just under $400 billion today. Of course, these numbers you would have to all adjust for inflation. But also commercial financing and trading have seen similar trajectories in their marketplaces at Wells Fargo, per that JP Morgan documentation. Over at Goldman Sachs this week, they reiterated their buy on the stock, saying that the lifting of the asset cap could drive Wells's earnings up 14 to 19% upside over the next couple of years. And they go on to point out that beyond the JP Morgan report, Goldman Sachs said that Wells may not just expand earnings by growth, but also by levering up more on the balance sheet than they could under the Fed's restrictions, noting that they still, of course, Wells falls under the same stress tests and capital requirements that all U.S. money center banks are subject to since that great financial crisis of 2008. In fact, Jamie Dimon went on to say in his, I don't remember if it was the Reagan speech or one of his appearances this week, that he finds those, in his opinion, to be a bit of a joke since they do what he considers to be hundreds of more elaborate stress tests internally each year. But either way, Wells will certainly still be subject to those rules. We wouldn't want them to get too crazy now and start repeating the mistakes of the past, but there is a lot more efficient use of capital than certainly the day before this cap was lifted. Under Scharf, they don't seem poised to return to the times there. I think he appears to, I don't know him personally, he appears to have some conviction. He appears to take his mandate seriously and the limits of moral hazard for banks seriously. And he said that the regulators forced the bank to make management and board changes, and the regulators were right to do so. He keeps repeating that. Maybe that's the public relations coaching at place, but they seem poised to do the right thing. The bank today is traded at about 12 times earnings, which is pretty low on a historic basis. Actually, it's a bit higher than it was a couple of years ago. 2 years ago, it hit a trough of 9 times earnings. But also today, it trades it according to facts, at 1.3 times book value, which is cheaper than the book value multiple it was 2 years ago when it was trading at 9 times earnings. Also, for those seeking compounding income, I think it'll be a dividend grower to watch. Its yield is about 2.5% today, so not incredibly remarkable, but I think that they'll be able to expand that dividend payout faster than the average bank out there. All right, that's it for me this week. As always, I appreciate you. I'm Chase Hinderstein. Thanks for tuning in to the Wise Investor Show.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.